It tells us that before the disaster, we had 100 firms and they each had a marginal cost of 0.5 Q. They were selling 20 units apiece at a price of $10. It said due to a natural disaster, the firms decreased to 54, their marginal cost went up to 1.4 Q, and demand increased. It says the state has a strict anti-price gouging law that prevents people from raising prices when there's a disaster. So basically there's a price ceiling, and that price ceiling is $10 because it says it won't let price go above pre-disaster levels. So pre-disaster, the price was $10, so we know we're going to have a price ceiling after the disaster at $10. And the question is saying, by how much does the law change the quantity of widgets purchased by customers in Big City after the disaster compared to what purchases would be if product price could increase? So there's a lot of information. First, let's just dissect it and see what we have. We know that there were 100 firms. Their marginal cost was 0.5 Q. Q was equal to 20 per firm, and they were charging a price of $10. Now there's 54 firms. Their marginal cost increased to 1.4 Q. They told us demand was 4,000 minus 200 P, and after the disaster, demand is 4,973 minus 63 P. So first, let's draw a graph and see graphically what we're doing. Well, this is before the disaster. We know the price was $10, and we were selling 2,000 units total because each firm was selling 20 units, and there were 100 firms. So 2,000 is our equilibrium quantity, 10 is our equilibrium price. Well, now that a disaster happened, the marginal cost of each firm increased and the number of firms decreased. This is going to cause supply to shift left. Meanwhile, demand increased, which we know increasing demand is a rightward shift, an outward shift. So we see that the new equilibrium price and quantity would be much higher than 10. So the new equilibrium price would be much higher than 10. The new equilibrium quantity would be somewhere around 2,000 still. But the idea is we're not allowed to charge a higher price because we have a price ceiling at $10. So now we're going to look at a couple things. First, we notice at $10, how much our supplier is going to supply? Well, we say, okay, so we hit the demand curve right here, and that's at Q ceiling. We're going to call that Q ceiling. So with the price ceiling, this is the actual amount purchased. Because even though demanders are demanding way out here, suppliers are only supplying here. So the amount actually purchased is way back here. That's called looking at the short side of the market, and in this case, with the price ceiling, the short side of the market is the supply side. So we see that what we're really looking for is where the new equilibrium quantity would be, which we said is somewhere right there in the middle where we see the new supply curve hits the new demand curve. So the answer that we're going to be finding is the difference between this quantity with the ceiling that's actually purchased with the price ceiling and the equilibrium quantity. So that would be the scenario if there weren't a price ceiling. If prices were able to rise, Q equilibrium would be the quantity purchased. So let's start. Well, we know there's 54 firms and their marginal cost is 1.4 Q. Further, we know that price is equal to marginal cost when we're talking about perfect competition. Well, we need to solve for Q in terms of P. So we do that. So price is equal to 1.4 Q. We solve for Q in terms of P, and we find that Q is equal to 0.71 price. So now let's take a look at what our supply function is. Well, we know that quantity supplied is big Q, and we know that there's 54 identical firms, so that's equal to 54 little q, where Q is actually equal to 0.71 P. So we can plug in 0.71 P for little q and find our supply curve, which is 38.57 P. So this is our supply curve. So quantity supplied at $10 is what we're interested in. That's going to be our quantity with the price ceiling. Well, we just plug in 10, and we see that our quantity supplied at $10 is 385.7. And again, that's our quantity purchased when we have a price ceiling. Well, to find the equilibrium quantity, we're going to set quantity demanded equal to quantity supplied. We know that quantity demanded is 4,973 minus 63P. This was after the disaster. Quantity supplied is 38.57 P after the disaster. So we set those two things equal and solve for price. And we see that price would have gone up to 48.96 if we had let it. So at 48.96, how many would actually be purchased? Well, we can plug that into either supply or demand. I've chosen to plug it into supply, and I see that the equilibrium quantity is 1,888.39. So to answer this question, we just need to find the difference in those quantities. Well, we know that with this price ceiling, we found that the quantity supplied was 385.7, so that was the quantity that was actually purchased. And now, if we let prices rise, we find the new equilibrium quantity is 1,888.39. So the differences between those two quantities are our answer.